It's time for On Point, where we speak to experts to delve deeper into some of the key issues in the spotlight right now. Just like we saw yesterday, in a move called a big step, South Korea's central bank delivered a half percentage point rate hike for the first time in history, raising its key interest rate to 2.25%.
Now, this is also the first time ever that the Bank of Korea has adjusted the rate upwards 3 times in a row. So what does this all mean for us here in South Korea? And will this move be successful in taming the current inflation? For more on this, we have our Professor SONG Soo-young with us at Chung-Ang University in Seoul. A very good morning to you, Professor Song.
Yeah, good morning to you. Well,
right, so what does this big step really signify for us here in South Korea?
I just mentioned that this is one of the biggest step in Korean Bank of Korea's interest rate hike. So what does this mean is the purpose of the interest rate hike is clear, that the Bank of Korea would like to deliver the clear message to the market, in the particularly the financial market, that the Bank of Korea is ready to protect and preempt the exchange rate depreciation, and also as well as the potential effect of the wage and the price spiral, or the demand side driven the inflation rate hike would be deterred by the Bank of Korea's step to raise the interest rate, and they are ready to raise the interest rate also.
That's right. Like you said, there are certain aspects to the move that there's many reasons behind this, but for everyday consumers, the most important thing is inflation, right? And you've mentioned inflation briefly, but the chief of Bank of Korea also said he will continue raising the rates. Will this actually tame the inflation? Is probably one of the biggest questions that everyday consumers are asking right now.
Clearly, as long as the Bank of Korea would like to take the risk of the economic growth, so risk the reducing the economic growth, and maybe even risk suffering from some recession, then it is clear that inflation rate will be caught, and there is no such a big inflation rate hike, such as in the United States, as you mentioned earlier, that the 9.1% interest rate, inflation rate for June. So that is very huge. But in Korea, it is relatively a little bit moderate. It's 6 point some percentage point of inflation, CPI inflation. So to that regard, we are not as risky as the U.S. economy, and also the employment rate in Korea is also currently very good, 62 point something percentage point. So unemployment rate relatively low, but clearly the biggest burden is household debt has been sold so much for the past several years. But the reason is we have to be careful interpreting, because household debt is borne by the not because the government aims to remain as the fiscal policy as robust as possible. So which means that the government debt has not risen as much as the other countries in the wake of the pandemic crisis. So that is all the burden would be borne by the shoulders of some household. That is a really serious threat.
Big risk. And Professor, so we saw in Europe that the euro depreciated to a level below the dollar for the first time since 2002. And well, there have been worries about a capital exodus here in South Korea as well. So what does this trend of currency depreciation really have for South Korea?
Actually, when I look around, well, according to the data set, actually the Australia, some days ago, the Bank of Canada has increased the interest rate very much. And most of the countries who are concerned about the depreciation of their own currency, then they begin to raise the interest rate. And the exchange rate, despite some strong dollars, because the dollar index has increased a lot, and even the euro and euro is equal to almost $1, so that is called euro parity, and has remained. So this means that I think the background of why this occurs is because of the collapse and burst of some such as crypto coins investment, and then all the funds has been flown into crypto coin investment has been flown back to the safe and the stable currency such as US dollar. That is the behind the force to make the dollar stronger than ever. So all these are driven by not because of the demand pull, but rather it is because of the supply side effect has prevailed. So the Bank of Korea do not have much to do with supply side, because interest rate hike does not produce more products, or they cannot resolve some supply disruption at all. So,
well, it looks like it's beyond the Bank of Korea's control, and
right.
I'm afraid we are out of time, Professor, so this is where we'll leave the interview today. But thank you so much, Professor SONG Soo-young at Chungang University of Seoul.
Yeah, thank you.